there is a nearly 80 basis point gap between the 2-year and 10-year Treasury yields. 0.80. It has not occurred like this since the 1880s. Early 1980s, when Chairman Volcker began attacking the inflation problem that had accumulated over a 15-year period. This inflation issue grew over a period of 15 months, and rather than raising interest rates to a range of 10 to 20, as Volcker did, interest rates have increased by 16 times under Chairman Powell. Many prominent businessmen and business people are worried that a continuation of the aggressive hikes could have disastrous effects on the U.S. and worldwide economies, as the U.S. Federal Reserve is expected to declare another interest rate increase. In an interview with Yahoo Finance, recently Cathie Wood, the founder and CEO of the investment management company ARK Invest, talks about concerns about a contracting U.S. economy in 2023, which are made possible by the central bank's record-breaking rate hikes. The well-known fund hedge manager compares the Fed's aggressive rate hikes to the rate hike campaign launched by former Chairman Paul Volcker in the early 1980s to address a 15-year loan inflation. She argues that compared to the federal government's present sledgehammer, Yoon Volcker's historic campaign was less intense, despite the fact that the inflation is not as severe or long-lasting. Similar comments have been expressed by a number of other chief executive officers and well-known hedge fund managers. Elon Musk, the CEO of Tesla and SpaceX, just issued a dire warning regarding the U.S. economy in the event that the Federal Reserve raises interest rates once more. His tweet says, if the Fed rises rates again next week, the recession will be considerably magnified. Musk has previously expressed concern about rate increases and how they would hurt the economy. The billionaire responded last week to a tweet from Vincent Yu, who stated that he anticipates a true economic recession in 2023. Here is Musk's response to the tweet that raised concern. The probability of a catastrophic recession is being dramatically amplified by the Fed, who urgently needs to decrease interest rates. Investors are growing more worried about the direction of the markets in 2023 as more and more people, including Elon Musk, Mark Zuckerberg, Michael Burry, Jeff Bezos, and others, sound the alarm. We would talk about the recession, our worries, and the significance of disruptive innovation technologies during our interview. As 2023 and beyond approach. To be fully informed about significant market developments, please watch the video through to the finish, click the like button, and subscribe to the channel. We'll now take you to Cathie Wood's interview. Additionally, be sure to share your thoughts and observations in the section below the video to aid in expanding its audience. Gratitude and good viewing. And yes, I do think that the current surprises will significantly fall short of inflation predictions. Therefore, we anticipate that sometime next year, the inflation rate will fall below the Fed's 2 target. Additionally, the pipeline informs us that there are excessive stockpiles of commodities that are driving up prices and necessitating various discounts. And the bond market itself signals that growth will disappoint, inflation will be lower than predicted, or both whenever the yield curve inverts. Does that imply, therefore, that Cathie and I won't be seeing, perhaps, a Fed terminal rate of 5 or higher? If we saw anything similar, I would be quite surprised. Despite a lot of potential support, I believe one of the most noticeable commodity prices out there, oil, can't take up. After Russia invaded Ukraine, it reached its peak at $130 per barrel. It is currently $74 less. Additionally, we believe that China's opening up is ostensibly supporting oil prices. It simply is unable to rally. I see that you are posting 7,160 here, but that would serve as yet another example. Therefore, I believe a shift in tone toward hey, maybe after 4.5% or a shift in language. We're not going up, but we'll get the market moving. The market is attempting to determine what level of high is. Additionally, there are some analysts and economists who believe you could be 6 or 7%. As a result, the market is being cautious and stating that further proof is needed. I now believe that the evidence is overwhelming. Since the 3.5 to 3.5% decline in long bond yields, the market for long-term bonds does not anticipate an increase in interest rates to 5 or 6. It has been moving against the current. On the 10-year Treasury note, we reached a high of 4 and are currently at a low of 3. So in my opinion, the bond market itself is shouting fairly loudly, which would be the most vulnerable to rates rising if they were traveling the other way. Well, if you look at what is done well over the past year or so, we have seen that inflation beneficiaries have done well. I just informed you that oil prices had decreased by approximately 50 from a high of 130 to a low of 70. The S&P Energy Sector Index, though, is still very close to all-time highs. There is therefore some disconnect there. You'll notice that our portfolio improves as inflation declines, interest rates rise, and the present value of future cash flows. We have stocks from businesses in our portfolio that will be very profitable in the following 5 years. They may not be making much money right now because they are investing heavily to take advantage of some incredible opportunities in the genomics industry, robotics, energy storage, artificial intelligence, and blockchain technology. They are investing now because many of these are going to be winner-take-most markets, which means they are huge markets. The gross margins in our portfolio consequently represent latent profitability, simply deducting the cost of products sold from revenues. There are substantial gross margins, and their investment in research and development, sales and marketing, and stock-based pay to recruit talent in these early stages is crucial to their success. The present value of future cash flows that are 5 years away increases when interest rates decline. In her interview she discusses the performance of her investment management company in 22 and the present worth of those increases. Many other top investors, analysts, and media personalities have criticized her strategy after her stellar performance during the pandemic and subsequent decline in 2021 and 2022. Many of them think she was only lucky in her pickings during the pandemic and may not record such astounding numbers again, but her belief in disruptive technologies is unwavering. Despite the market's ambiguity as a result of the bear market, the famed hedge fund manager has kept buying the shares of her most strongly held positions. Returning to the interview, the top American investor will continue to explore cutting-edge technologies and the risk posed by benchmark. A market like this has never been seen before. 809 is worse than this, and I believe that a lot of technicians basically looked at a chart depicting the tech and telecom bubble and burst and thought, okay, that's what's going to happen. We experienced that. Even more compared to the IT and telecom bust. This is worse. The difference between the two eras is that in the late 1990s, an irrational market began to develop. Investors are putting a lot of money into stocks and technology in an effort to outperform indexes and other investors. They ultimately had 40 technology. However, the technology was not yet ready. Cloud didn't appear till 6, I believe. Deep learning advancements didn't occur until 2012. The expenses were far too exorbitant in addition to the fact that the technologies were not yet available. For one person's genome, it cost $2.07 billion to sequence the first complete human genome in 2003. That's $500 today. The tools are available. Costs are so low that the seeds for the investments we're making now were sown over the 20 years that preceded the burst of the IT and telecom bubble. That was unreasonable. And I believe that right now we are on the opposite side of the bubble. I consider the current situation to be unreasonable. Many of our stocks have fallen below their lows from 2020 when COVID hit, and some have returned to their levels from that year. Likewise, a business like Teladoc, since its gross margins are in the upper 60s, its revenues have increased 14-fold. We envision entering the 1970s. See what I mean about lateness and profitability? Compare that to the Nasdaq's 43 gross margins. They have a lot more money to spend on building this foundation for their healthcare, but it still makes a loss, right? Returning to high gross margins in the mid-60s and low 70s. This is what I mean. Because we think this company will eventually become the backbone of healthcare information for the United States, if not the world. Its profitability will be superior. Just consider the gross margins in the high 60s and low 70s compared to the Nasdaq 43. Despite this, the company is trading for, I think it's around 2 times revenues as opposed to 3.25 on the Nasdaq. On the downside, this is just as illogical as it was in the early 1990s on the upside. Investors are afraid to deviate significantly from their benchmarks as a result of the IT and telecom implosion, and even more so as a result of the 0809 catastrophe. They sell any stock that is not included in their benchmark when we enter a risk-off period, which includes our stocks since they are not included in the benchmarks, and it has progressed to a remarkable degree. But if you ask where the risk is currently in the market, I believe it is in the benchmarks that everyone is crammed into because they are so outdated. Additionally, our portfolios are perspective. The majority of people do not build portfolios in the same way that we do. They require their standards. We require the best businesses to carry out the future of these 5 new platforms. We think them are included in our portfolio too. Given the difficult times we've gone through, I have no other explanation. We would be a wonderful diversifier, even if that were the only benefit. We believe that the conventional world order is really risky for people who are adhering to benchmarks. The market is prepared for an announcement of a 50 basis point increase on Wednesday. Anything above will have a negative effect on asset prices and increase market uncertainty. What do you think of Musk's tweets and the Woods interview? Do you believe Wednesday will bring about the much-needed Fed pivot? Put your thoughts and opinions in the space provided here. Additionally, make sure to check out our other videos. Subscribe to the channel and like this one. I appreciate you coming.